Okay, yeah, we need about 2,300-2,400 bucks an ounce, and then the market will start participating. Then you get there and it's like, we probably need more like 28. Now I don't even know. I think we probably need 5,000 before the regular investor wants to partake. And I don't think the Western investor has any real allocation to gold, maybe 1 or 2% max.
During the run up to $2,900 an ounce gold in the GDX, shares outstanding went down 20%. No one believes in this sector. People are selling out. People look at gold. They're like, oh, gold's too high. Therefore, the miners must be too high as well. It's like, no.
Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. All right, welcome back to another pod. Today, the markets are tanking, but gold is on the move, and the money flowing behind the precious metal is setting up for what I think could be a once-in-a-century opportunity. But the real question is, who or perhaps what is going to capitalize? Today's guest has spent decades inside the markets, from the New York Stock Exchange trading floor to uncovering multi-bagger opportunities in the precious metal space long before anybody else saw them coming. He started as a Wall Street trader, moved into derivatives trading in London and Ireland, and became one of the more respected gold analysts out there, with some of the biggest players in the industry following his work. He's a CFA, a CMT, and a keynote speaker at top gold and mining conferences around the world. After years at Stansberry Research, he now runs the Golden Portfolio, where he's tracking what he has dubbed the golden anomaly, a rare market dislocation that could be the biggest opportunity in gold stocks today. And from my experience over the last 20 years or so, when these types of opportunities appear, history shows that the opportune entry point doesn't really last that long. So if you're serious about navigating this gold market the right way, I think you're in the right place today. So Garrett Goggin, welcome to the pod.
Thanks, Aaron. That was a great introduction. I appreciate it.
My pleasure. So you started your career in traditional finance, typical Wall Street financial situation, and then you jumped to the derivatives market. Now you're into gold. That's a pretty unique jump, considering, Wall Street rarely, if ever, really touts the gold sector. What made you decide to dedicate your professional life over the last, decade plus in the precious metal space?
I've been with Stansberry Research and with Gold Stock Analyst for 15 years. I just went independent to bring you the truth and start the Golden Portfolio last year. It was a great year. We're up 140%. It's just, we are a minority within the vast investing public. We're just wired that way. And then the traditional Boston financial community is so boring. It's invest for the long term. Everything will be okay. The market always comes back. But, what if that isn't necessarily the case? So I've always been wired towards alternative assets, and we've seen this play out with gold outperforming the S&P, over a decade or 20-year time frame. And, we're in the Keynesian long run, where everything starts getting wacky. It's a debt-powered economy. Everyone is strapped out in finances, and there's limits to it. And we're at the ends of it. And Treasury Secretary Scott Bassett knows we're there too. And he said, we need a global reordering. That's why I want to be involved. And there's something major coming down the line.
Yeah, I agree. Actually, I want to make this a little bit orderly. I tend to jump around, but let's touch on this golden anomaly kind of thesis of yours. So as it relates, to equities, you've dubbed these current times as sort of a golden anomaly. What is it, and why do investors need to know about that?
Yep. So a lot of newsletter writers, they throw out the chart of gold up here. They throw out the chart of the GDX down here. They're like, there's your opportunity right there. GDX is going to close the gap. GDX never closes the gap. Like, we're going to have rallies in the GDX, 100%, 200% higher with the major miners. I think we're at the cusp of one right now, but it's never going to close the gap with gold, because you're comparing apples and oranges. You're comparing the world's supreme reserve asset that's been a stored value for 1,000 years, that has, no liabilities, that represents no one's liability, basically is no fees or expenses attached to it. You might have to pay a little bit for storage, versus gold stocks. All stocks are valued the same way. A stock equals the lifetime free cash flow over the asset's life, right? And you get gold miners. gold miners and the stocks at Agnico, Sean Boyd just said out, they have 13,000 employees. That's a drag on earnings. When inflation pushes gold higher, mining costs rise as well. That's another hit on the revenue that is increasing with the higher gold price. You have options, marketing, just everything, right? And the average miner has been unable to increase free cash flow on a per share basis for 20 years. And I track this stuff. And if you track, the profits per share versus the share price, there's like a 96% correlation. There's very few miners that are able to do this. It's very hard to do this in the mining industry because you're paying hundreds of millions of dollars for an asset, hundreds of millions of dollars for CapEx. And over the life of the mine, how much profit, free cash flow can you actually squeeze? And the majority of the time, it's not enough to cover the payment and the CapEx. The large cap miners, they don't care because they're getting paid. The big boys, millions of dollars a year, the CEOs, and all they have to do is maintain production, and bankers get rich off all the deals, and the management get paid.
Right.
So the golden anomaly, you need to dig deeper. You need to dig into the profitability of these miners because there's some hard truths regarding the mine industry. The average investor doesn't like miners because when are miners worth the most? They're worth the most on day one of production, right? Because as you mine, the reserves drop. You start going along the curve to over a 10-year life of mine, usually longer due to exploration upside. But at the end of year 10 or 13 or 20, you're left with a depleted asset that represents a liability. So $1 worth of free cash flow discounted at 5% a year is worth 7.7. And that's what the miners have historically traded at. If you look back to 2015, the average multiple is 7.5. And then growth stocks trade at a 20x or 30x because they have that growth multiple applied to the last year, right? So you get the 7.7 and then you get the extra $30 and it's like 7, multiple. So there's intrinsic truths regarding the mining industry, the way institutional investors look at them. And I'm able to navigate in between the mining industry's setup in order to find value in the troughs of the Lassonde curve. Because since I follow profits and free cash flow, I track the average miner all the way back to 2015, and I do it on an all-in sustaining cost margins. If you track all-in sustaining cost margin versus the share price, 96% correlation. The average miner is selling at a 24% discount to fair value on a regression with the share price. This is the largest discount since 2015 and before that 2020. And what happened in 2015 and what happened in 2020? We had Fed action. In 2015, the Fed was hawkish. They reduced their bias. Gold went on a tear. In 2020 was COVID. And we all know what happened. The Fed came with the tremendous amount of monetary stimulus. So, I see this happening right now. The economy's weakening. The GDP Fed now has been running at negative 1% or 2%. Trump's getting rid of a lot of government employees. Like, the economy is not good. The Fed's going to pivot soon, and that's going to spark a fire under the gold miners. But that's speculation. See, do you play blackjack at all?
I have. Yeah, I have.
Yeah, so I play blackjack. Not often, when I go to Vegas, I'll play a little bit. Yeah. When I do, I count tens in the deck. Count tens, non-tens. And when the deck is rich in tens, that means you're going to get blackjack more often. That means that the dealer is going to break more often. So you load up. It doesn't mean that you're going to win every hand, but you're going to win a good percentage of them. So when I find free cash flow trading at a discount, I am paid to wait, and I don't care what the gold price does because good things happen to strongly profitable miners with strong free cash flow. Some of my biggest winners have been based on a 20% free cash flow yield. It was Silvercrest Mining back in 2015 that was acquired, spun out Silvercrest Metals, went on a tear. Newmarket Gold, they had Cosmos, Stalwall, Fosterville.
I know that story well. I was an investor as well.
And it was extremely undervalued, so I got it. And then they got lucky, right? They started having hits at Fosterville, right? And then it got bought out by Kirkland, then bought out by Agnico. Just tremendous value creation. And, that's what the odds, that's what my numbers are telling me right now. I do a lot of quant stuff due to my background. And the last time gold stocks were this undervalued was 2020. And you know what happened in 2020?
That was a good
Buffett came in and bought Barrick.
Well,
right. So, one of my, what I've been saying is Buffett's going to come in and buy Newmont, because Newmont blew out earnings 2 weeks ago. All the standing cost margin is up to like $10 per share. The stock price is lagging. It's trading at a 48% discount to fair value based on, quant regression versus a share price. So to be honest with you, I don't really care what the gold price does. Obviously, I'm happy when it goes up because it pushes value into the miners. Irregardless of whether the gold price goes up or down, these miners are so undervalued that even if the gold price drops, the stock price still has to go up to match fair value. I just look at gold as being the cherry on top of the whole ice cream sundae of value creation, right?
Right.
Through exploration, through de-risking, through getting production and permits. You're adding value every step of the way. And my golden anomaly is when I dig deeper and measure the free cash flow of these miners versus the enterprise value market cap. I've never seen an opportunity like this, and it's wacky because gold's at $2,900 an ounce.
Yeah.
Yet the miners that have kind of not performed great, they're hanging in there a little bit. But the gap, right, between profitability, where these things should be and where they are now, is the largest I've ever seen. I love some of the developers right now, like Montage Gold.
Yeah.
Yeah. Backed by the Lundins, Kone. You know what that's worth at $2,900 an ounce gold? It's worth $3 billion. You know what it trades for? $400 million. I'm surprised.
When you say $3 billion, you're valuing per ounce in the ground?
NAV basis, based off profits and free cash flow, based off their latest feasibility study, and you just model it with $2,900 an ounce gold. So the profits are staggering. Rio 2, Alex Black, he did it with Rio Alto, and he's doing it again with Rio 2 at Phoenix. Big heap leach open pit, run-of-the-mill ore, needs no processing. It's worth $1 billion. Stock's languishing at 200 mil. I'm surprised some investors that specialize in other markets haven't come in yet to take out one of these companies because of the profit opportunity that it shows. And this is kind of my I mean, I'm a gold bug. I've born and raised in Vancouver. I've been around the mining world, for a better part of my life. I believe in it. But this is my gripe with gold miners, right? Is number one, like you take Barrick, for example, which I own. It hasn't done anything in 20 years. Nothing.
And I had Peter Schiff on a couple weeks ago, and we were talking about Barrick specifically. And he says, look, the problem is the one or two serious analysts that cover some of these major gold miners, they're projecting $2,300, $2,400, $2,500 gold in a year or two. They think the main asset's going to go down in value.
Yeah.
But I attribute that to a lack of understanding, but also the gold miners are terrible at marketing their stories.
Yeah, I've had this discussion at a couple of recent presentations and conferences. I don't think it's marketing. Someone was saying that marketing, they need sexy marketing and blah, blah, blah to compete against crypto. I don't think they need marketing. You know what's sexy? Profits are sexy. Money in the bank is sexy. And I can show you a chart of Barrick versus free cash flow per share or profits per share. The stock price tracks profits per share. That's all people care about. So as a mining industry is producing this free cash flow per share, the stock prices are going to be going up. It's going to start with the majors, and then it's going to filter into the explorers and developers, right? And then as the money comes in, it's going to light a speculative fire underneath the stock price of these, and the rising stock prices will bring the average investor, chasing the next hot idea.
I don't doubt that, sadly, because retail rarely gets in early. Again, you've been in the markets a lot longer than I have, but I've been in the commodity world for 20 years almost. I have seen a market that you're talking about, like that speculative fever where the majors see a crazy market capitalization appreciation. It trickles down developers, juniors, and so forth. But I mean, the last time we saw that was probably 2009, 2010.
Correct.
And, the whole narrative in the gold space has been, hey, you want leverage to a rising price of gold? You want 2x or 3x? Go for the miners or go for the explorers and developers. But gold, the metal itself, has outperformed the miners and the developers and the explorers. Like, I don't know what's going to change that. That's my concern.
If you look at a chart of the gold price versus all the miners, 95% of them underperform the gold price. As you said, the only one that's outperformed is Agnico. Why?
Yeah.
Because they've been able to grow earnings per share, and they've been able to increase profits on a per share basis, and that's the only thing that pushes the share price higher. 2011 was a major peak, speculative bubble. And I just think the average major, it's too large of an organization. They're afraid to do anything that's politically incorrect, or they're afraid to step out of the box and do things that their competitors are not doing. But, the speculative frenzy in 2011 was marked by Ty Burt paying like $7 billion to CEO Kinross for Redback.
Yeah.
Like, why weren't you buying Redback at 50 mil instead of 7 bill? It's just, it's ridiculous. And then I track a lot of metrics regarding the GLD ETF, since it's an ETF, when money comes in, shares go up. When money goes out, shares go down. The GLD ETF is hundreds of millions of shares lower than the last peak, and way lower than what it was in 2011. During the run-up to $2,900 an ounce gold in the GDX shares outstanding went down 20%. No one believes in this sector. People are selling out. People look at gold. They're like, oh, gold's too high. Therefore, the miners must be too high as well. It's like, no. Like, that's the current consensus on the street. And, I'm the minority that just it keeps talking about the value that's being offered by the industry right now.
Yeah, it baffles me because, we've had these conversations with colleagues of mine and myself, like, 2 years ago, because we're always involved in the gold market in one degree or another, but two years ago we're like, okay, yeah, we need about $2,400 an ounce, and then the market will start participating, and then you get there and it's like, we probably need more like 28. Now I don't even know. I think we probably need 5,000 before the regular investor wants to partake. And I don't think the Western investor, the typical North American investor, has any real allocation to gold, maybe 1 or 2% max.
Yeah, nothing. No one's touching it. Everyone's like, gold's too high. I missed it. I don't want to get involved. Regarding, gold at, 2,300 to make money, when inflation pushes gold higher, it pushes mining costs higher as well. So the low-grade, uneconomic moose pastures that were unprofitable at $2,000 gold, they're still unprofitable at $2,900 an ounce, and they're going to be unprofitable at $5,000 an ounce. So I'm just saying that as a warning because, I'm out there on Twitter a lot, and you see a lot of promoters out there promoting these low-grade, moose pastures that they're never going to be economic. They might go on a run when gold really gets ripping, but, due to the dilution and unprofitability, they just revert back to their, lower prices after the run's over. We get runs like that 1% of the time, 2% of the time. I invest in the miners that make money 98% of the time because the miners that make money 98% of the time, those are the ones that outperform. Look at Lundin Gold, right? Fruta del Norte, cashing it in. And I passed that up because it was trading at over $1 billion or $2 billion. And that was one of the best performers because it's extremely profitable. It was undervalued on a free cash flow basis. When you have a lot of profits in the bank, you pay dividends, you buy back shares, you do shareholder-friendly acquisitions and build more shareholder value. So, that
Fruta del Norte is an interesting one because it was such a disaster for Kinross, right? And it's kind of an example of the power of management and their ability to execute, right?
Yeah.
And so to your point about some of these juniors, I think they're a necessary evil, the companies that go after the greenfield players or the moose pastures. You almost have to have those guys because discoveries are so hard to come by. Every now and again they hit. I know it's a huge failure rate, but it's a necessary evil of the industry because the majors aren't going to go out and make new discoveries, or very rarely will they ever. So you kind of need that funnel, but that funnel doesn't work if there's not a lot of excess capital flowing into the space, right? So this is, and I'm going on a long tangent here, but this is why I actually become more bullish on the gold space over the last 2-3 years, is because there haven't been, I could probably count on one hand the major discoveries made in the gold space, 3 million plus ounces in the last 5 years, right? So discoveries are becoming harder to come by, which makes me more bullish, but still nobody knows about the story. The retail investors paying attention to crypto or the NASDAQ or ETF of some sort, passive investing. It's hard to get the attention of that retail investor these days, which concerns me.
I agree with you. I think it's about money. I think it's about profits. I think as money starts flowing in the sector, like you said, my forecasts are based, I use the current gold price every day to model free cash flow, right? And as you said before, the average analyst is modeling in at $2,300 an ounce. And the average buy-side investors modeling these earnings at $2,300 an ounce. Yeah, but gold's not at 23. I don't care about your expectations. All I care about is reality, and right now, year to date, the average gold price is $2,805. And as every day ticks by, it's going to lock in that $2,900 an ounce for the first quarter. And these earnings are going to blow away estimates. And I think as that happens, people are going to start readjusting their outlook.
Yeah, and I was going to actually ask you that. Where do you think all the bias comes from with these analysts for these low forward guidance pricing on gold? But I just think it's dogma. The sector's been quiet for so long. They don't want to show bullishness. They're scared or whatever it may be. They don't want to step out, right?
Yeah.
So jumping on to another interesting one, because I know you're a guy who looks for opportunities in the space. I own juniors, majors, producers, explorers. If you had to pick one part of the gold market right now, the equity side of things, majors, mid-tiers, or juniors, whatever, royalty companies, where is the best asymmetric opportunity in the gold space right now?
You got to maintain a portfolio, right? My GPNX is 30 companies, because you might love a story and you're like, this is the next one. You're very often right? But if you have a portfolio of 30, you're going to have a few that are really going to rip. And don't sell your winners. Hang on to your winners, because there's something intrinsically right going on, and they're going to continue moving higher versus the other ones that go down. And they're going to grow to a larger share of your portfolio and power your portfolio gains, during this gold bull run. But as far as like risk versus reward, like we're looking at fully permitted miners. Rio 2 is fully permitted. It's going to be in production next year. They're building it out right now. Alex just tweeted something out. They're laying down, their heap leach pads right now. So there's only a 1 year to production. They have all their permits. They're de-risking it every step of the way. And you're stepping into a situation where it should be worth $1 billion, but it's only trading at 200 mil, and lower risk every step of the way. Just the value being offered, the spread between where it should be and where it's at. I guess I like the developers right now.
Yeah. I agree with that. Actually, I definitely agree with that. I mean, obviously they don't carry the same risk as the explorers, but they've kind of been bucketed in with that exploration group. At least from what I've seen, it's like, they're not in production, forget about them.
Yeah.
Right? So I do see opportunity there.
I can't believe a major hasn't come in and taken these out, because you're paying 200 mil, you're getting a bill at the current gold price. Montage, paying 400 mil, you're getting $3 billion. It just shows you, I don't know, the majors don't care about increasing free cash flow on a per share basis. They're more about managing risk and other variables. But one of my other products is the golden portfolio. It's royalties.
Yep.
Royalties are the best way to play gold, because they've got 4 or 5 employees. All you need is CEO, a lawyer, a geo, and you don't even you can farm that out, hire consultants. They have fixed costs, right? So even as the gold price goes from 29 to 3 to 5, their costs never change. So their margins increase. Royalties get free exploration upside. Pierre Lassonde paid $2 million for Homestrike. They've gotten $500 million back from it. They're going to get another $500 million through exploration upside. And then there's a massive consolidation wave that sweeps through the royalty sector on an ongoing basis. All the good ones with world-class assets, they all get snatched up. And then, since I do quantitative stuff, I'm like, what if you just made a royalty portfolio? Since 2007, when Franco got spun out, you'd be up 13,000 or 16,000% now, versus the miners that are like trading at the same level. But the royalties are boring. It's like watching paint dry, but it's 24 karat gold paint. When the gold market really spikes, they'll trail. When the gold market goes down, they hang in there much better. And that's what it's all about. It's about minimizing losses and, making gains along the way.
What are a few royalty companies that, viewers can go do some due diligence on that you would recommend they take a look at?
All the smaller ones, in my experience, with good assets, they've all been bought out. Origin Royalties owns a 1% NSR in Silicon Merlin. That's owned by Anglo. Do you know Silicon?
No.
Oh God, Silicon's in Nevada. Anglo's been slow playing this. It's like deep in the MD&A. They rarely talk about it, especially now.
Where in Nevada, like the Carlin?
I think it's below the Carlin trend, south of it.
Okay.
Yep.
Okay.
So they've already discovered 13.3 million ounces of gold at Silicon Merlin. It's near Bullfrog.
Yeah. Okay.
And then they just increased their resource by 20%. Now they have 16.3 million ounces of gold. In year 2, they also released a very rough economic forecast. In year 2, they're going to be doing 1.6 million ounces of gold per year. That's before the resource update. Like, this is a 2 million ounce a year gold mine. They drilled for water just to make sure, right, the aquifer hole, make sure they're going to be able to. They found more gold. Origin originally found it through using Avarice data. There's a NASA website, AVERIS, and it's satellite pictures of the entire world. And their geologists use a little AI and computer stuff to analyze, regions around Nevada that look promising. So they staked it. Origin spent $100,000 staking this project and exploring it a little bit. Now that 1% NSR is equal to 100,000 ounces of gold. Like, the value creation is ridiculous. And, since I have a newsletter, I like writing the research. I like doing the analysis, but I have to market too, right? And the newsletter series, a bunch of guys who don't know what they're doing these marketing campaigns. And they're like, oh, learn how to buy an ounce of gold for $100. And I got one better. Get an ounce of gold for $1 with Origin. And Altius owns a 2% NSR in Silicon Merlin. That's worth ridiculous amounts of money. So between the two of them, I don't know if they're going to join it together. It would be the world's best royalty, or sell it off, or someone comes in and takes out one or both companies. I don't know.
Very interesting. I want to just touch on the macro side of things, because Trump's obviously changing the landscape of the global economy and more. But as it relates to gold, Trump's policies, I don't know how serious he is about following through on some of these tariffs. Maybe he will, maybe he won't. Maybe it's a bargaining chip. I don't know. But what do you see with Trump's tariff policies, his kind of, America first, almost protectionist approach? How does that translate into rates? I think it's probably going to help bring rates down in some way, shape, or form. And also, what does that do for the price of gold over the next, call it 2-3 years? Are you bullish? Do you think we've kind of hit a top? Where are you at on gold's price in relation to what Trump does?
Yeah, I gave a presentation in Germany last November talking about Trump and how his policies is going to be great for gold. Because Scott Bessent was going to be Treasury Secretary. Scott Bessent's major holding was gold in his portfolio. I think he had Treasury Secretary.
Yeah.
Trump is friend of Judy Shelton, who he tried to get in the Federal Reserve Board, who's a major gold bug. She's proposing a 50-year U.S. Treasury bond backed by gold. But there's so many things going on right now. Like, I can speculate where it's going. Gold's coming back into play. You get Elon Musk tweeting out every day something about auditing Fort Knox. And Eric Sprott came out and said they're going to be very surprised when they audit the vault and stuff like that.
What do you think about that? Do you think the gold's there, or what? As they say it is, and they mount it?
I think the gold's there, but I think backers do what backers do, and it's loaned out 100 times over, right? You give your money to a bank. Here's $10,000. What do they do with it? They loan it out once, twice, 3, 10 times. That's how they make the money. You get gold and the inert asset sitting in a vault, not making any money. They loan it out. So that paper trail is 100 times more than the ounces of gold held in Fort Knox. And then what I believe is the reason why gold's going so much higher and all the gold's coming back to the U.S. is because U.S. banks are being forced to cover their paper gold shorts. Yeah, and then you get Basel III kicking in too in July, right?
This is interesting. So run us through in layman terms why there's this, I don't want to call it repatriation because that's not what it is, but why is the gold coming back to America? This has been a story that, hasn't really been covered in the mainstream, but it's a story. Break it down for us. Why is it coming back to America? What's going on here?
Because, the COMEX is, where the majority of the world gold is traded, the volume on it, the futures contracts outstanding on it. And then, you get this gold sitting in a vault and, it has claims to it. JP Morgan owns a lot of it. Chase owns a lot of it. But, they have this gold sitting in a bank and they loan it out, right, to a counterparty. There's a lot of hedge funds. It's like the yen carry trade. Hedge funds are short the yen and using the yen to finance their other trades, right? Because it yielded so little and it never really went higher. Hedge funds have been doing that with gold. So hedge funds will come to JP Morgan. It's like, hey, can I borrow 1,000 or 100 tons of gold? And it's like, all right, here you go. Another, hey, here you go. So you have these claims on this gold that are going to have to be covered.
Interesting. So when we say covered, explain that part of it. So the gold comes back to be covered, but what does that actually mean? What's the mechanism? Like, who needs to cover the short specifically?
If you're short gold, you need to deliver the gold back to the source, right?
Yep. Yeah. But why wouldn't we have seen this years ago? Why wouldn't we have seen this last year? Why is it happening now? Is it just because, I guess, at some point you just have to cover and the gold price has been rising so consistently that they're like, enough? Is that basically it?
I don't know. I think Trump's policies are coming into play right now regarding this. You get Basel III kicking in July, which makes gold a tier 1 asset. Yeah. And that's not paper gold. This is gold that has to be held as allocated gold that you can't loan out. And then you can build your reserves off that. But paper gold is worthless now. You get that going on in July as well.
Interesting.
Yeah.
So with Basel III, like who wins in Basel III? Like who benefits from it? So gold, yeah, of course, people who are invested in gold, but what's the principal reason behind it? Like, why do they want to make gold a tier 1 asset in the fiat world?
I think to shore up the banks, because there's this whole derivative paper trail and the whole economy is extremely leveraged and they're looking to rein it in a little bit, I believe. I don't know. This is just mere speculation. Like, at my heart, I'm a, gold analyst and I can analyze that all day. This stuff's fun to talk about.
Yeah, it is.
And, I try to stay away from, well, gold's going to 5,000. Gold's going because it's like, what value is that? What I have seen, though, is a lot of the European countries, they hold 4% of their GDP in gold. The U.S. holds 2% of the GDP in gold. I could see some sort of gold standard coming back, backing GDP to gold. Now, this is a politically acceptable solution because you're backing growth to gold, not debt or money to gold, right? So you can continue the massive spend, but it's like, hey, we're paying a GDP to gold.
Right.
Yeah. So I haven't really heard this get much play. The France central banker has been talking about it. Dutch central banker has been talking about it. It's Scott Bessent, knows that they need a new sort of Bretton Woods agreement or Plaza Accord. So I could see this coming down the pipe.
Interesting. Well, I think you've given our viewers a lot to chew on, myself included. Before we head out, where can our viewers find your work, learn more about what you do? Where can they find you online?
Yeah, just go to Golden Portfolio. I have an introductory product. I also have a free Secrets of a Mining Analyst Masterclass. You can sign up for it to get more of my knowledge.
Beautiful. So again, with the Golden Portfolio, high level, what is it about? Is it about finding specifically mining equities or just opportunities in general within the gold market?
It's mining equities. I have the Golden Portfolio product, which is based off the royalties. I have the GP10X, which are their extremely undervalued explorers and developers. And then I have the GP4 that are 4 or 5 of my top picks.
Perfect. Well, we'll include a link in the description as well as to all your socials. Garrett, just want to thank you again for joining me today. It's been a great conversation, man.
Awesome. Thanks, Aaron. Thanks for having me.